And make sure you look at these scenarios as if, what if it's you, okay? What if you get sick? 3, the worst case scenario. What if life happened, freak accident happened, and let's say you didn't make it?
Some people are telling you, you know what, I'm young, I'm not gonna die. I'm 40, I'm 30, I'm 25. But guess what? Like Nyahoko was saying, being young doesn't have anything to do with you getting sick. It doesn't have anything with you actually passing, because getting sick or dying doesn't really choose about your age. And there is a reason. These policies, they call them life insurance because they are for the living. Really, life insurances we do have out there are really many. It's not one. Now, nobody's going to tell you there is only one type, but you have to understand the best one that you need to have for your family.
Okay, perfect. So we are here to talk about finance and how you can protect your income on the things we go through daily in life. We have a lot of time to go to work and make income for our families, and we go to a job and we simply get money to pay our bills, right? But have you ever thought about, okay, if I can't work or if something were to happen, all the what ifs in life that can happen to you, with you being the main person bringing in income for you, you and your family? There's a lot of things that we have no control over in life, okay? So the only thing we know is we work, we provide. And as long as God is good to us, we will be able to do that throughout, right? So we're talking about protecting your family and protecting your your finance for your future. Retirement savings, if you live a long time, we have living benefits if you were to get sick, and if you die too soon. So we're going to go through all the what ifs in life. If things happen, what plan do you have as a person, as like a husband or a wife or income earner for that household? Okay, so the first scenario, and make sure you look at these scenarios as if, what if it's you? Okay, so that way it makes sense to you. So scenario number 1, let's say you live a long time throughout, your childhood, your teenage year, adulthood, all the way to you being elderly. Okay, what do you have in your savings, or what do you have planned for you, since you are now an elderly person, you can't work, you are retiring? Most of us in America, we are taught about 401k, putting your money in 401k. That's most of the stuff that HR will go through when you are doing the hiring process. The bad thing about that is they don't go in detail what the 401k is. And if you were to ask somebody, oh, you have money in 401k, what does that mean for you? No one really knows. They just know that, oh, it's a retirement account that I have, and that I can enjoy the money whenever I retire. They don't tell you the pros and cons about it. For example, that it has a downturn with the stock market, right? They tell you, oh, you put in your money and the company will match you whatever percent that they're going to match you, and that you will be able to take it out when you are retired. Now, 401k is the main one, and Roth IRA that everybody knows about. So let's say you put your money in there, you have 25,000 in there, and the market crashed tomorrow. Maybe you'll have 20,000. Okay, and then the next week the market is great again, and now you're back to 25,000. In our mind, it looks like we actually gained something, but you really just gained what you lost. You didn't surplus anything from what you started before. So that's the one thing that we know, is that it goes with the market. If the market is bad, then your money goes down. And it's very limited to how you can enjoy it, because when you are 65 or older and you are able to now take out this money that you've been putting in for all this while, you are being taxed on it, because remember, you didn't pay taxes when you were putting it in. So they will charge you taxes once you are now ready to take it out. If you didn't take it out early than retirement age. And all of us know, those who lives in America for a while, we know that taxes goes up as the year go by. So that's one thing that they tell us, is that, oh, 401k is the way to go, way to put in your money. It's better than nothing, for sure. But what is better than 401k? Do you know anything better than 401k that will reduce your chances of getting taxed, or reduce your chances of getting like higher fees and managing that account? So we have choices where you can get tax advantage for your retirement account. Okay. So scenario 2 is you live a long time, maybe your money in your 401k doesn't go very far to take care of you in your retirement age. What now? What do? Because we know that we don't really save. We can try to save and save, but with the way that our economy going, you don't really save much to take you through. Most people go to retirement, run through all their retirements, and then go back to work. We've seen it. We have a lot of elderlies in Walmarts, and you can name it anywhere. That's because whatever they thought that would see them through with their retirement just doesn't keep up with inflation. Okay. So scenario 2 is, what if you get sick? What if you get sick along the way? So you are now a provider of that household, whether you're the male or the wife, or worst case scenario, you're a single mom or a single dad. Your income is solely depending, your bills are solely depending on your income. If you go to work, you get a check, you pay your bills. But what if you get sick? Do you have any plans on how you're going to pay those bills? Because on average, in America, millions of Americans are diagnosed with heart attack, stroke, and cancer. And the worst part of it is, it's an average of 43 years old, in your 40s. You're still young. We don't choose when we're going to get sick, right? We don't choose if we're going to get sick or not, what kind of illness we're going to get. It could be genetics. You could be as the most healthiest person as you can. You don't choose when you're going to get sick. This is a prime example. I go to 24-hour fitness. If you are in the upper, or east, west, and south, 24-hour fitness. I go there and I have an instructor who teaches body combat. There is at least a good 30 of us in her class every Tuesdays and Thursdays. She is this little old thing. She's built. She has muscles, 5'3". Very, very, when you look at her physically, she's healthy, right? But a couple of weeks ago, she informed us after her class that she's been diagnosed with breast cancer. You look at her, she doesn't look like someone who can be diagnosed with something like that. She looks so healthy. But genetics can play a big role in whatever illness that we can get. Okay, we don't choose it. But with me thinking like I'm just going to go work out, that's just my me time. I want to just go and de-stress. I never thought in my head that, I should tell her something like that, because for one, she's white. I'm in my head, I'm thinking like, oh, maybe she already know this information. I'm not thinking like, okay, I need to extend whatever I know to her. Well, she get diagnosed, I feel so bad, because why I had information that could have helped her. I could have gotten her a policy. I could have informed her of what other choices she has, besides us doing a GoFundMe for her, which we've done. A lot of us in the gym, we pitched in and we did a GoFundMe for her. But that could have been avoided, right? That could have been avoided, and if you know this information. So with that being said, we don't choose when we're gonna get anything. It's a matter of time. So if you get sick, let's say you get sick, you can't work for a whole year or whatever. It's a chronic illness, it's a cancer or stroke. Those are very harsh on our bodies. If you stop working, you stop your paycheck. If you stop your paycheck, your electricity company, your water company are not going to say, oh, because you're sick, we're going to postpone until you feel better. No one waits. No company waits for you. Okay. You have to pre-plan all of that for yourself. You can get sick and you can be sick for a year or two. This is how people become bankrupt, because all the bills will pile up. They will pile up and you cannot pay anything because you can't work. On top of that, your coverage, you're only covered with health insurance with your job if you're working. If you're not working, there goes your health insurance as well. So it's good that you protect yourself in case you get sick and you cannot work. You have to see, how can you pay your bills? What are other ways that you can pay your bills? How do you protect your income? Is your income protected? Because when people think of life insurance, they think of, oh, life insurance, I have to go and then the people behind me will enjoy the money. People don't think of the new modern day life insurance where, what if I get sick? I can still be my beneficiary and take my income or take my death benefits and pay all my bills while I'm sick and I can't work. That's what people don't know, and that's what we want to be able to explain to you guys today, is that you have to critically think of plans on how you can protect your income. Because at the end of the day, no one is gonna, no company, no mortgage company is gonna tell you just because you're sick you can't make your mortgage payment. Okay, kids still gotta eat. Electricity gotta be paid still. If you don't do that, it will pile up for however long you stay in. So that's scenario 2. You get sick, how do you replace that income while you're sick? What if you're scenario 3, the worst case scenario? What if life happened, freak accident happened, and let's say you didn't make it? Is there anything that you put aside for family? Let's say you scenario 3, you do have this policy, you have this account. Worst come to worst, you pass on. Your paycheck is gone. But if you have this policy, all of your bills, including taking care of your family, will be in great shape because you set them up to succeed. Okay? So your family, your bills, everybody will be taken care of because you took that initiative to get an account like this. Life insurance is not just for the death, but it covers all of those what if. It covers you if you live too long and you can't work anymore, you retire, they're tax-free. Okay? If you just get sick and you get diagnosed with some critical chronic illness, you'll take it out. You'll sit down, you won't work, and your income will be replaced. You won't lose your income just because you got sick. Okay? Scenario 3, worst case scenario, you passed. Your family, your home, all your bills will be taken care of. No one, it's going to be as stressful to mourn when it's very stressful to mourn with somebody who passed away when you have all these bills piling up, or how we're going to take care of mom's house now, or how we're going to do the bills. Everybody can pitch in and do GoFundMe, but it's never enough to take care of your family and all the bills that you left for them. Usually GoFundMe only puts you to the grave, but it doesn't take care of your kids. We've seen it in many of our communities where somebody passed. Oh, so-and-so passed. Oh, we got to put our hands together. The amount that we put our hands together, we put that person to the ground. But guess what? All the bills are still there. They are gone, but all the bills are still there. But you could be scenario 2. You didn't die. And usually with most illnesses, you don't die just because you get diagnosed with that. You don't have to die. You could still get your money. You could still get your death benefits while you are still living in scenario 2. You're just ill. You can pay your bills, and you can just focus on getting treatment. And who knows, within a year or two, you might be well and back to optimal. At the end of the day, your bills are still paid, and now you're back to being healthy, right? There's nothing wrong with that. So you cover all of your bases, you protect your income, you protect your family, because you don't know tomorrow. You don't even know 30 minutes from now. Okay. So that's what I wanted to inform us of today. I'm gonna have Emma continue with the rest of our with the rest of our education. We try to do at least, one, so that way we get all the bases covered and have enough time to answer your questions. And that way also too, you can go back to whatever you're doing. I know it's getting late and kids have school or just came back from school. So you might want to go cook for them, put them to bed and all that. So we appreciate your time. I'm going to hand it back to Emma, and then she's going to continue with our education. Okay.
Perfect.
Go ahead and take it.
Thank you so much, Nyahok. I love it when it comes from someone who is, I respect most, someone who has a great experience, not only in the finance part, but also someone who works with us when we get sick. So when she talks about sickness, really, it hits home because she's a nurse. She works with the people who are ill, young, old, so she knows it all. Thank you so much, Nyahok. That was very, very touching and interesting. And again, as I said, get your pen, jot down your questions, Lily. We don't want to lecture. We are going to have time. I'm going to go after Nyahok, Lily. I don't have to speak so much because she has nailed it. Lily, life insurance. Why did I call it life insurance, first of all? Because along the way, when we work with our people, some people are telling you, you know what, I'm young. I'm not going to die. I'm 40, I'm 30, I'm 25. But guess what? Like Nyahok was saying, being young doesn't have anything to do with you getting sick. It doesn't have anything with you actually passing, because getting sick or dying doesn't really choose about your age. And there is a reason. These policies, they call them life insurance because they are for the living. Really. Our topic is financial literacy and money matters. We don't just talk about life insurance because as time goes, we're going to be touching other financial topics that are very crucial for us. For example, if you want to buy a home, how do you build your credit? Really? If you want to live a financially free life, how do you put your taxes together? So we are here to educate one another, to learn together, to be able to manage our finances in a good way. Back, like I was saying, we have been doing these discussions really going back. Before maybe I bring in the topic I need to discuss, starting from where Nyahok ended. People keep confusing about the kind of life insurances we do have. The life insurances we do have out there are really many. It's not one. Now, nobody's going to tell you there is only one type, but you have to understand the best one that you need to have for your family. Because, for example, like people who are professionals, you have a job that gives you life insurance at work. Those life insurances at work, they call them group life. It's not even listed here, unfortunately, because it's not even considered a good type of life insurance. You can see we have like 3 kinds of life insurance here. That group life is not even listed. You know why? Because that is not your policy. A group life, they call it a group life because let me say you work for Amazon. Amazon will go buy a life insurance from Fidelity or from whichever company, AIG, and Amazon. It's a group life insurance for Amazon, named Amazon as the policy owner And then everybody who works under Amazon is going to have those little pieces. You're paying your money, the company is subsidizing for you, possibly you're not paying much. That is why you're happy that you protected. But guess what? The moment you leave Amazon, you're going to leave that policy there. And what we always tell our people, why we want to really discuss this, unfortunately, most people who are actually would think would know, they tell you, hey, actually, Margaret, for me and my family, we are very well catered for. That was me like 10 years back. I used to work for corporate. I had the best insurance place I thought I had for my family as well. But the moment I left the company in 2014, that was it. I lost it. All the money I contributed towards that group life, I lost it. Not only that I lost the money, if I had started my personal life insurance, it would have been cheaper for me. You know, the earlier you start these policies, the better for you and your family. For one, you're young, you're paying less premiums. Two, who knows? When you're younger, you're healthy. You don't have anything, any chronic, any terminal. With life insurance, for you to be able to actually be approved, there's what they call insurability. If you're lucky, you're healthy, nothing on your record, you're good, you're insured. If something is showing on your record, that is what they call losing the insurability and you're not able to get in. And if you are, let me say you worked for, you know, whichever good company you work for 10 years, 15 years, you get out at 45 or 50, you're trying to get your own, it's going to cost you an arm and a leg. You don't want to do that. So the reason really we come here to discuss is for people to know their options, to know what they have, you know, because you already making a good choice to take an insurance for your family is also the best way for you to be able to pick the best one. So among actually the ones that are recognized here, we're going to discuss, we have like 3 types here, because even that group one, although I brought it in because I know most of our people rely on that, it's not even considered as a life insurance. Even for those financial professionals here, you know, when you're giving someone an insurance, they'll ask you, do they have actually a current insurance? Do they have one? They never consider group life as an insurance because it's not, that is not theirs. I just want to throw that in there because it's not even here because it's not actually a good option. So among the ones we have the term life, guaranteed life, and then we have the index universal life, which is a darling to so many. Every time we come here, we discuss about it because we want our people to really know their options and pick the best option they can get. As you can see, the first one, which is term, as the name says, really is for a short term. They give you term of years. You may get 10, 20, 30. The company work with really is very generous. It gives 35. I never say that it's a bad one, but it depends on what you want. As you can see, this policy here, the term life, doesn't have any cash value, meaning that when you get it, you're only getting protection. You're protecting your family. For sure, I'll tell everyone, people will say, oh, that is not a good one. But let me tell you something. If you cannot afford the other ones, take even the term, because guess what? 35 years is a long time. If you have a home, it's paid off. If you have young children, they're already grown and already have their own jobs and they are taking care of themselves. Or if you're lucky, they will take care of you when you're older. It's better than actually a group life. And the good thing, they're telling you it has no cash value, lowest cost, really. Anybody who works, it doesn't matter how much you make, anybody can afford to have a term life. That is the advantage. The first, number one, no cash value, that's a disadvantage. But again, when you buy a car insurance, you have no cash back. When you get your home insurance, you don't get a cash back unless your house burns. That's not a cash back. They're paying for a peril, but they're not paying you back. So it is expensive in long run. What they mean is, because it's term, you might buy it when you're 30, they give you 35. At 65, it is gone. So you're not insured. meaning that the reason they're saying it's expensive in the long run, if you're 65 and your term life is gone, although it's convertible, if you want to convert it into permanent, guess what? They're not going to start from where you started at 30. They are going actually to start where you were at 65. So it's going to cost you a lot of money. So if time allows it, we can even learn like a quick illustrations if we do have time, but we know time is very important. So that is why if you have a term life, know that you did not make a mistake, but know exactly what you have. Yes, for 30 or 35, you're 100% protected. And the beauty of this, all our term life insurance come with living benefits. I'll explain more about the living benefits. Living benefits means that because these insurances, they call them life insurance, you don't have to die. Like Nyahok was explaining, if you happen to get sick, a critical illness, a terminal illness, a chronic illness, you can actually access your money while you're living. So with that term, although it terminates at one point after 30 or 35 or 20, whichever years you chose to take, during that time, in 30 or 35-year term, if you're, God forbid you get sick, you can actually access your money. That is a plus. That is good. I'm not telling you that is the best one, but if that is what you can afford, please, my dear, get something. At least get something until your finances allows you to get something better, but do protect yourself. So then we go to the guaranteed universal life. That one, take this out. Okay, so the guaranteed one, the difference between that and the guaranteed, this one actually is like a whole life. It covers you at to any age. So the level premiums, guaranteed level premiums to any age. If you start paying, it's not going to change. It's going to be there. You actually can get some return of your premiums. So you can get some money back. That one sets it apart from the term because term has no cash back. This one you can get some money back. It's a little different from that. And again, all the products we do have, they all come with the living benefits. Again, it's not about just when you die. No, when you get sick, you are covered. When you die, you get a tax-free death benefit. And even when you get sick, you get tax-free living benefits. Like we're saying, you cover anything you could have covered while you're working. And then we have the best one we have always telling people, the Index Universal Life Insurance. This one comes with the retirement cash values or cash accumulation, like we always tell people. So this particular one covers you up to 120 years. We all know no one is possibly going to live up to 120, but who knows? One of us might go there. So telling you 120, it is actually guarantee. You have a guarantee that you covered for life. Let me say, like Nyahoko was saying, you're not critically ill. You never got sick. You're healthy up to 100, but at the end of the day, you're going to go. So whether you go at 70, at 90, at 100, it is going to happen. So you still need to protect yourself. So this particular one, so it's actually linked to the index gains, whereby you're not just protecting your family. So the index account comes with two components, the protection part and the accumulation part. The protection part protects you whether you get sick along the way. You have the living benefits. If God forbid something happens and you're gone, at least your family and yourself are protected. If you're working and you bring in a check to pay for your mortgage, to put your kids to school, protect yourself. Like it protects yourself and your finances, whether you're living or when you're gone. Because if you're working and you're gone, you go with your check. Then what happens to your family, like Nyahoko was telling us? Those beautiful kids or the wife, everybody's looking up to you to eat, to have a roof over their head, to go to school. If you're gone and your check is gone, that means you're gone with everything. But this Index Universal Life, because you covered up to 120, you are very well sure that whether it's today or tomorrow or 20 years to come, you're 100% covered. Again, I think Nyahok touched about that. The index universal life because it has those living retirement benefits. There is no downside to your savings. Like she was comparing, I believe one of these weeks we're going to bring actually to do a comparison on our savings, whether it is the 401k, whether it's a Roth IRA, even the IUL, even the annuities, so you can see what is your best option. Like you were looking at the different types of life insurance, even the retirement planning, we have different types of product you can choose from that are more beneficial to you than the ones you have. So we're talking about the living benefits. So what are the living benefits really? So the living benefits are those because we say this insurance is actually for the living. That is why they call it life insurance. What do they cover? The critical illness riders, those the heart attacks, the stroke, cancer, like plus they did plus additional illness, the illness triggers, anything that attacks your life and stops you from working. It is actually not even life insurance doctor that will approve. Your personal doctor will have to approve that my patient is critically ill, is no longer able to perform, to work, to do anything. So as long as they approve, really, you're going to get your money. Let me say you took $1 million policy on your head. You're protecting your family, you're protecting your finances, and you get critically ill, you're not able to work. You're not going to suffer waiting to die to get the benefits. So actually the insured here, someone who takes the policy, the insured also becomes their own beneficiaries. In a way, when they get sick, they actually their own beneficiaries. They don't wait to die for their kids, their wives, or their husbands to get the money, but they can actually become their own beneficiaries if they ever get a critical illness or those crazy illnesses, or even a chronic, anything that long-term care, you're not able to work, who is going to take care of you? For people who have maybe older people, they know how expensive that can be. That's why people choose to go into nursing homes because they can't even take care of themselves. But if you have your money, you don't even have to suffer that way, because we know long-term care can be too expensive, but when you have the money, life becomes easier. Then the living benefits includes also the terminal illness rider, where they tell you you have less than 20 months to go. They pay out 100%. Actually, the terminal and the critical, they pay 100%. If they tell you you have less than 24 months to go, you go take care of your finances and your home. You have a home, pay it off. You have children in school, make sure you know how they're going to stay, because you're going to go anyway, but it's better at least you know how you plan your finances before you leave. And remember, all these living benefits riders are included at no additional cost. So all the policies we have, be term, be IUL, all these living benefits comes to you without paying a additional penny. So why not? Why would you choose to take something at traditional life insurance when you can have one that comes with everything? So people, can you try to mute, please? Okay, sorry about that. Someone was in there. So yes, so whether you have any kind of insurance, really, when we come here, we're coming here to educate ourselves, to make sure that all the decisions we make, really, we make the best decisions, because everything we do today is going to affect our tomorrow. That is why we come here, to learn together so we can be able to support one another. So some people will be like, hey, so what is it that does that pay? The living benefits, they pay your medical expenses. Again, they pay off your mortgage, college funds, bucket list. Bucket list is like, you don't just pay a mortgage, but you have to eat. Even that home, if it's paid off, you're going to pay taxes, you're going to pay utilities, or those are the bucket list. Everything you need to use your money for, you can use those living benefits to actually help you keep the life going. So that one is an example of this doctor, a medical doctor who happened to take a life insurance actually, they said a few months, not even months, this doctor was diagnosed with a throat cancer, and he took home $734,000, and in a few months, he was cancer-free. So you can see how living benefits actually really save lives. People actually really connect life insurance with death, but maybe Nyaho can tell us better. Most people get sick, but they don't even die. But when you're sick, you can't work anyways. So you're there, but you're not there because your family is looking up to you, but you cannot actually do help because you're not able to help yourself as well. So we also have like the index universal, so the index universal life with F and G, it protects your wealth, the greatest wealth accumulation and the wealth preservation vehicle of our time, we say. Why is that? You're protecting yourself, your life, and then your wealth. When you talk about wealth accumulation, remember, you're not just protecting yourself from dying, but you're also protecting your future when you retire. Today you're working. Let me say nothing ever happened to you, but you have index universal life. That index has two components, as we said, the protection part, just in case something happens, and then the accumulation part for your future. Nobody wants to work and then end up on the streets begging because you made a bad choice saving for your future. Don't get me wrong, we all work really so hard. But when you look, I always tell my people, look at your W-2 or 1099 at the end of the year. Look at how much money you made in a year and do yourself a favor. Check your savings account and tell me how much is in there. Really. It is sometimes, it is like really hard to look at it because you're like, did I really make this money? Where is it? That is why actual saving for your future is very, very important. As we saw here, the money comes in and the money goes out. So if you're not smart enough to think about your future, you may end up actually retiring with nothing. Or if maybe you happen to save something with your 401k or anything, it's not going to be enough for you to live on for a long time. So when they show us here the 4 phases of retirement planning, really, we are comparing the 401k. It's a small comparison. It's not going to be a big one, really, because we're going to take time to pick a topic, to compare these two fully in details, to show you how this works. So when you're looking at your retirement, most of us really have our retirement money into 401k. I think Nyaho could touch it a little bit. For people who have 401k, if you have not looked at it, really, they tell you they take money, pre-tax money, meaning that the money they put in your 401k is not taxed. That's what they say, phase one, when you actually contributing, they're taking money out of your check, they don't tax you. They're not taxing the seed, but look what is going to happen on your proceed. So when you put in your 401k, it's not taxed, tax deduction. They don't take money out, Phase two, you're accumulating, they're not taking anything. But when time comes like for distribution, that is why your income is going to be taxable. Imagine they're taking maybe $500 a month or $1,000 a month. They're not taxing you. But when you're about to take it out, you have 500,000. Imagine the tax bracket you're going to be in. It's going to be humongous, So you'd rather actually tax me today because I'm able to work and don't touch my retirement, because that is what I'm going to be relying on, because I'm not going to be working. But check on someone who chose to take an IUL, for example. So you see, I'm already taxed because the money I'm using to get an IUL is already taxed. It is after tax money. But guess what? On these other phases, accumulation, distribution, transfer, tax-free death benefit. Imagine that. If you have $1 million policy and you pass, your family is taking a fully tax-free death benefit. But if you were able maybe to start working early and you have $1 million policy in your 401k and you're gone, they are going to tax that big chunk, and the tax bracket they're going to put you in is going to slash your money into half. So nobody wants to do that for sure. That is why they are telling you, is it smarter to pay taxes on the seed or the harvest on your retirement savings? Would you rather pay money today, your taxes today, and be sure that your retirement savings are safe? So this is why really we come here to educate ourselves. We work so hard and we want to make sure we protect our dollar. So this guy, I think everybody knows Warren Buffett. So he has the two rules he tells you. Rule number 1 says never lose money. And number 2 says never forget rule number 1. So never lose money. If you go back here, you don't want to lose your dollar. You don't want to lose your money. Leave alone that, the money that maybe is going to be taxed. But even the money in the 401k, like Nyahoko was saying, if you have your money in the stock market and the market crashes the same way it did back in 2022 during COVID, you're going to lose more than 20. Most people lost more than 20% of their money. But people who had money in their 401k, remember, you can never ever lose your principal. Even if the market goes down, you have actually your money flattens. So everything is locked in until the money, actually the market rebounds. So like this guy tells us, he knows so much about money. Never ever let your money go because you work so hard to get it, to make it. So this is about actually retirement assets. They show you how, if you have money in the market, how the market goes up and down. We'll get more time to talk about retirement and the assets. But tonight we wanted to go through, like this one, for example. They are showing us if you have money in the market, what happens. Really, this is the market. The market goes, sometimes it goes down, it goes up, it goes down. That is the stock market. Let me say, people who love to play money in the market. You can sometimes get good money, but when the market really goes bad, you're going to lose everything. But when you look at the blue line, they're showing you, it's not always like really shooting up, but when the market is not good, it flattens. It never ever, like here, it flattens, it never like goes down, but it is flat. And then it goes up, it flattens. That is when the market is bad. But when it flattens, you're locking in all your gains. You're not losing anything. So like our friend, Mr. Buffett says, we have to make sure that we protect what matters actually most. So it looks like we have a few minutes left, really. We have some good reads for people who love to read. If you have time, go read it for yourself. It's not something we just, these books are out there in the market. The Power of Zero, go read. There are some good reads, really. We can pin them in there if you want us to pin them, or you can take a picture there on your screen. We're going to save a few minutes left. Lily, I'm so sorry. It looks like time is running out. We're going to save some time for everyone to be able to ask some good questions. We know you've been listening, and we want to learn from you as well. So the floor is open. If there is anyone who sent, maybe if you don't want to talk, you can even send a question in the chat. We'll go in and look at it, and then we'll be able to discuss and learn together. I thank you so much for listening, and we want to hear from you, what you have learned, the questions you really have about anything that we talked about. Remember, this is supposed to be an interactive session. We want to hear from you as well, because we always learn when we come here and listen to everyone. Thank you so much. Mr. Emmanuel, please go ahead.
Thank you, Immaculée. Thank you very much for the great presentation. It's really good and very exciting to see all these numbers and to learn so much about something very important to us, to our families, to our communities, and to our friends and the neighbors. I just have one comment and one question. The comment I have is, I was going through the list of people on this platform today, and I'm very happy to see a lot of my people from our community and friends of ours. The challenge I have for them is, I see some people from the churches, from the medical field, from the from the accounting, insurance. These are professionals. Challenge I have for you, except for Imakile, I think nobody else on this platform from my own community who ever talked about it. So let's challenge ourselves. If you go to any of the church, especially those who are going to the Hearst Church, Pastor Mani Church, I see Gigi here, Gigi, I see others, I see the DFW professionals team. Guys, let's have our community's member learn about this one. We don't need another surprise again. It's a challenge I have. Let's talk. Let's see how we can help our people. In the nursing, in the medical, those in the different sectors, please talk to your neighbor, talk to your friend, talk to your coworker, so they can get all this benefit, because this is something really we didn't know until recently. So now it's our time to, as we learn, let's ask questions, let's take notes, and let's also educate others. And if someone cannot join the team as an agent, as licensed person, they can join as a client. So that was my comment and the challenge I had. One question I have for you, Makile. You mentioned about how people can start small and go, and build up, because sometimes the income is not as income and the bills, and it's not as easy as people may predict or may be excited about, but things change over time. So people can start small and then increase. Can they increase their life insurance, or they can increase the cash accumulation bracket? So I get confused. Guys, everybody on this platform, I'm new too, so I'm learning. I was just having that kind of question. Thank you.
Oh, thank you. Thank you so much. So that is actually very good. Thank you for your comments, Lily. That is what we all wish for, to learn together and be aware. Be aware and be able to protect ourselves. So when it comes to your question, when I was talking about starting small, I was trying to explain about the term life insurance and the index universal life insurance. The term life insurance is like the cheapest you can ever find out there on the market. Very, very affordable, but it terminates at one point and it doesn't have cash benefits. But I usually tell people, we all own a car insurance. Do you get cash back? No, you don't. Do you own a home insurance? Do you get cash back? No, you don't. So what I mean when I say start where you can afford, if you're really in a financial situation, you cannot afford to buy index universal life that we know is the best on the market. It's the best for you today, tomorrow, and the future, because you're going to lock in everything. You start young when you buy a universal life. You start younger, you start with lower premiums, they will never change. Even if you get sick tomorrow, all your life is locked in. That is the perfect place I would say is the best. But even with an index universal, people may say it's a little pricey, but to me, it's the most, actually the cheapest one, because all your money comes back through accumulation. Remember, when you talked about cash accumulation, when you put in your money, it grows for you. You're protecting yourself, you have the protection part, which is the life insurance, and then you have cash accumulation. So the cost today looks bigger, but in the future, it's the cheapest you can ever find on the market. But let me say you cannot afford to start higher today. You can even start with a lower amount. Everybody doesn't have to have $1 million policy, my people. You don't need $1 million policy. Buy what you can afford, protect your family. When your finances changes for the better, go increase your index account. Index account is the most flexible account you can ever find. You can start with 200,000, you jump to 500,000, you jump to $1 million as you wish. Or if you can't afford even that, take a term life. I believe there is nobody who works who can't afford $50 a month. to protect your family when you pay 200, 300 to protect your car. I tell people, you protected that car and you buy 100% like full coverage, but that car will never have a crash without you sitting in it. Have you ever thought about that? You're protecting a machine you bought for yourself. It can crash, it becomes a total loss. You buy another brand new car. It happened to me 2 years ago, 2022 August. I got into a crash. My car completely became a total loss. I have a new car now. But imagine if it was me who crashed. I have no spare parts. I can never be replaced, but that car was replaced. So think about what you're giving a priority in your life. Is it your belongings or is it yourself and your family? So that is actually very, very good, Mr. Emmanuel. Really, take what you can afford, but have protection over your head, over your family. At least if life allows, you can go beyond. So we have another one. I don't know if you want to take it on, Nyahok. We have other 2 questions in the chat.
Somebody said, explain more about living benefits and it differ from medical insurance. So I think what they're asking is your regular medical insurance that will protect you shall you get sick, right? How is it different from IUL and with its living benefits? I'm assuming that's what the question is asking. With IUL, we were talking about how you can get your money while you are still living, because living benefits is basically that you're living, but whether you get sick, you still, whether you live a long time, you still get it. So yes, you're paying into your policy, but like what Immaculate was saying earlier, you essentially will get it back, because unlike a car that you pay an insurance onto every month, you don't get it into an accident, you don't get that money back. With medical insurance, it covers medical, like it doesn't cover your mortgage. It doesn't cover your bills, right? So you, all of us, majority of us, at least for tax purposes, we have to have medical insurance. So it's exactly what that is. It just covers your medical bills. If you get sick, your hospital, it pays the doctor, it pays the hospital, but it doesn't pay your bills. So that's the difference between your medical insurance and the life insurance or IUL with your own policy, is that if you get sick, yes, the medical insurance will cover the medical part, but it doesn't cover your home situation. So living benefits will cover your home situation, all of your bills. I don't know if that answered your question. There's another question if you want to take it. Hello, my question is, the money increase when you paying on your benefits? Can you elaborate that question for us a little bit so we can answer it properly? If you can come to the mic, please.
Yes, I think I don't know the way to asking, but I was asking sometimes maybe like you're putting 20,000 on your life insurance. Is it and like the end of the time you wanna go get it, you can find it's increasing, or you're gonna find it's still 20,000, no matter how much you keep working on your maybe you're paying on your payment. How to express it, this one.
That is understandable, Clementina. That is actually good. So I think you're talking about
because what I tried to say, because I don't know if I heard somewhere say maybe when like the insurance, you take insurance, the more the way if the more you keep paying, or the amount you put in, maybe let's say in 2 and 3 years or 5 or 10 years, you find is increasing maybe 5,000 on it. That's what I'm trying to ask. I don't know if you understand my question.
Yes, Clementina, I think we can try to understand that. So I believe you're talking about the index universal, where you grow your money. So remember, your money is actually in the index account is tied to the market, but on the index where you earn actual interest on your money.
Okay.
let me say you start off, so you actually have a chance to put in what they call a lump sum. You might have
Okay.
even like less money sitting in your account. Remember, guys, we have money sitting in our savings account or checking
Yes.
account. They're giving you 0.01. In the market today, even when the market is now doing the best, we are earning over 7%. That is what these big banks do. They get our savings money, they put in the index account, they earn 10 or 12 or 13, they give 0.01. So yes, your money actually grows tremendously. You actually like have your $1 million protection. By the time you retire, you have like another $1 million for your retirement only. Yes, actually, that is why we always say, please reach out to someone who invited you, because this is a global discussion. We're now going deeper in details to discuss for you like on an individual basis. So when this conversation is done, please reach out to someone who invited you so they can take you through deeper into actually what that means. That is a great question, Clementina. It's really very good.
Thank you. I understand it now.
And you guys think that all of these living benefits are like great. Once you get with that person who do invite you and they go into detail, you will see how there's even more benefits like cash value that you can take out tax-free. You will get that within your one-to-one with the person who invited you here. So there's more to learn. Since this is general and we're just scratching the surface. That person who invites you, all your questions, they will answer them, and just make sure you jot them down in your notebook and get an appointment with them, okay?
Go ahead, Mr. Kaiz. Thank you, Mr. Go ahead, Kaiz, Mr. Kaiz.
So thank you all for the discussions. And just to add on to what Ms. Clementine was asking and your observation, the government knows how good this Index Universal Life is. The IRS knows how good it is. And that's why they put the tax codes that govern how well these accumulations have been used and abused by some people. There's a tax code 7702 that I have talked about, which happens to be where people have been taking money from offshore accounts, trying to put them into these Index Universal Lives as tax shelters. So when that does happen, then the insurance companies do monitor, and there have been situations where they have actually been able to combat some of these illegal practices. So the IUL retirement accumulation is a very, very good vehicle, and it is protected by the government, where some people have been using it because of the growth in it, and because they want to keep it as a tax-free benefit when being withdrawn. These rules do apply, and for those naysayers or the people who are doubting about this growth, this is a very, very good tool. And being in the tax business, we're all able to get some more information on it. Thank you so much.
Yes, sir. Thank you. Thank you. It looks like we're really closing to our time, but we don't want to go without answering any question. We have actually linked the YouTube. You guys are going to be the first ones actually to see it, because we haven't shared it to the public. So you actually the lucky ones. So we have pinned it in the chat. If you want to copy it and take it yourself, you'll be able to see all the previous discussions we have had. Anybody else with another question? We don't want anyone to go without asking something. We know we had decided we'll keep the time, but since we are here, we want to learn. Go ahead and ask any questions you may have, please. The mic is open. Thank you.
There's questions in the chat, Immaculate.
Okay. Let me see. What we had. Is there anything we jumped? If someone
Okay, it says, yeah, somebody, last question. It says, how can someone become an agent? I think that's our last question.
Okay. Okay. So really, when we come here, we focus on educating ourselves, but at the same time, for our communities to be educated, we need more educators. And it doesn't matter how much knowledge you have on these financial matters, you have to be licensed. So again, if someone, one of the licensed agents here invited you, please reach out to them. They will learn you through this, the way the system to actually help you become an agent. Remember, we're talking about savings, but this is also a very, very good business that you can do for yourself. When we talk about financial freedom, really, and financial literacy, let us not be mechanical and feel like, oh, I'm a nurse, I cannot move. I'm an engineer, I cannot move. I'll tell you, in this business, you can make money. And the beauty of it, you can make money while you're supporting your communities. So reach out to someone who invited you. It will take longer for us to go through with everybody to show you how to become an agent or to become a financial professional. So please reach out to someone who invited you. Will be able to support you in any way you need. Thank you. Yes, ma'am, Serafina, please go ahead.
Yes. Thank you, Immaculate and Nahok. I just want to make sure we answer people that ask questions in our chat. So there's 3 questions in there. I have Inosa. He asked, as the agent, is it okay? I think he meant telling people not to take 401k.
Okay. No, we did not say that for sure. Remember, 401k for people who are working and you work for a generous company that is actually matching what you put in. That is free money. Don't leave money on the table. But remember, there's some people who work for company A, B, C, D, and then after 2, 3, 5 years, they leave the company. So if you're leaving the company and you're no longer getting a matching, that money can actually be transferred to a qualifying account, which is in this part actually, you can actually transfer your money to an annuity. An annuity is a qualifying account. You're not going to lose anything. So don't leave your money in an account that you're going to where you're not going to grow good money. Put your money in a safer account that is going to help you grow more money and actually help you not to lose money. I think that is clear. So no, we're not telling you not to stop. We're not saying that for sure. We're showing you the best options. Thank you. Okay.
All right, we have another one from Tall, and his question was, 401k, are you? So he said 401k, are you mean tax you while you are working? Then when you take out retirement, it will not tax you? Is that what you mean?
Actually, that is the opposite.
Yeah,
So yeah, so when you putting in money into your 401k, right? The company put it in, you get your check. The company writes your check, right? For example, you work for 40 hours, the company will give you a check. Out of that check, before they take the tax out, they will take your 401k out and put it into your account. And then they will tax, and then they give you your paycheck. So they're putting it in without you paying taxes. They're taking it out of money, your total general, your gross. So let's say you made $1,000 that week. They haven't taken the taxes out. That 1,000, they will take that portion of that 401k out and put it into from your check and put into your 401k, and then they will tax and then give you your check, right? So the longer you have your 401k, the more money you putting in. What they do is they don't tax it now. So when you turn 65 or you turn 80 and you're ready to take it out, it's not 1,000 anymore. Now your 401k is 800,000. So they will tax you from that 800,000. So that tax, depending on the bracket that you will be, which will be higher for 800,000, they might take 400,000 and you will be left with 400,000. That's half of your money that you lost, if that makes sense.
Thank you.
All right. So last question from the chat. Momo iPhone said, "Hello, what is the difference between term insurance and permanent? Please explain."
Okay, so when you talk about permanent, I don't know if she's talking about the ones that we have in there. Let me say permanent. If when you compare permanent, I might compare the difference between term and index universal life, because that is a permanent life as well. So the difference is term is a number of years. You have 20 years, you have 30 years, you have 35, which is the maximum. That is comparison number one. The term life has that maximum, 35. The whole life or the index universal life for this case is 120 years. That is a difference. The term life doesn't have cash back or cash accumulation. The index universal life for this part accumulates money. So those are like mainly the two main ones. The one is permanent, it doesn't end, the other one ends. Actually, for some reason or for good reason, most of these policy products were given the names that actually define them, term and permanent. So this one ends, this one doesn't end, the other one accumulates money, the other one doesn't. So that is what it is. So with the term, really, term is very, very affordable. That is why I think most people tend to be able to take that because they feel like I'm paying $20, $30, $40, $50. I'm not feeling it, but you're going to feel it at the end when it's gone and you have nothing.
Okay.
Yeah.
All right. Thank you, everyone, for coming. We are going to wrap it up just to respect everybody's time. But in general, everything that we were talking about today, we're not telling you to not take one. We're giving you all of your information and you decide out of all the information you got, what is best. 401k, we would never tell you not to take 401k if you're a person who's working and being matched. That's good. Keep on doing that. Anybody, even if I have my own policies, IUL, get my 401k because I have free money that my company is giving me. Why would I take that away, right? We're just explaining good and the best. And you choose out of all of them. We're not telling you, don't take this one, take this one. Okay, we're just giving you the information, and based on the information you got, you choose off of that. And if you have any more questions, like we said earlier, you're going to go back to the person who invited you. They will go in detail and links, however long you want, okay, to make sure you got it. Because the whole point of us doing this is to make sure we educate everyone so you choose what's best for you and your family, okay? So that will conclude our meeting today. I'm happy that you guys take the time to learn something for yourself, for your family. Take it back to your friends, take it back to your family, let them know what you learned today, and let them come back again next Thursday. We do it again, okay? So get back with the person who invited you. We thank you for coming today. Y'all have a good one.
Good night, everyone, and thank you
Good
again
night.
for coming.
Thank you, everybody, for coming.
Thank you.
Good job.